Hello guys, welcome to the show. Listen, worked all morning trying to get a video cam working. I got a new cam. It'll shoot in 4K. Of course, I don't need 4K for YouTube. YouTube 1180p, 1080p is fine. It'll shoot in 1080p too, but I can't get the audio to work. Tried everything. Maybe it's something I'm doing in software programs or something. Can't seem to get it working. Anyway, I just figured I'd tape this off on my cell phone. And then I'll put it on the air, If nothing else works, the cell phone will work, The cell phone's got a pretty good little camera on it. But you got to hold it in your hand, so it's a little bit shaky, And I think the audio quality is fair, probably pretty good. Anyway, what I wanted to talk about is we are in a mess. It's not just the world's economy. Everything, there's a whole series of problems out there that could cause a chain reaction where everything could start to collapse. And, I could go on to list all the problems. Maybe I'll list a few of the major problems out there. One is the corporate debt market. It's over-leveraged. We got Deutsche Bank, huge problem. I can't see that going away. I can't see them solving it, and I can see Deutsche Bank going down. We got the Chinese debt problem and the Chinese slowdown, the general slowdown in the Chinese economy. We've got trading issues between Russia and China where Russia is bypassing the use of the dollar in trade. Huge. Has a huge impact on the dollar. We've got the South China Sea and Taiwan. China is really upset over Taiwan. We've got the protesters in Hong Kong. Oh, and I'll tell you what, guys. My heart goes out to the people in Texas and also the people who live up in Ohio, I guess it is. Anyway, there's two extremely, terrible. My heart goes out to you guys, your families that are involved in this. Anyway, we've got huge problems in the world. That all of this seems to be coming to a head at around the same time. And it's frightening, to tell you the truth, what's happening. Because once it gets started, one of these problems will trigger the next one, which will trigger the next one, which will trigger the next one. It's called a domino effect. So if, say, for instance, Deutsche Bank goes down, it'll trigger the debt market to basically implode on itself, and then these other problems within the debt market, like the corporate debt and everything, and the stock market, everything will just fall all at once. Any one of them can trigger it right now, because it's all like it's ready to go. It's all ready to turn over. And there's so much in so many different places. I didn't even name the Brexit problem coming around right soon. It's almost like, it reminds me of back in the Wild West or whatever. The Indians, you used to have a test of bravery for the young brave. And he'd have to run through something that they called the gauntlet. And basically what it was the Indians would be on either side, and he'd have to run through the center of them, and they would just be like hammering him. And that seems like what we're going to go through is like a gauntlet, of problems that if they all fall at the same time, and that's what it looks like, what's getting ready to happen, well, the system will just basically melt down, and there'll be margin calls that'll go out. Now, if you guys don't know what a margin call is, basically what happens is, and they can talk about this until they're blue in the face and say that there won't be a mark-to-market. But in fact, when the debt starts to melt down, that's exactly what they'll do. They'll mark-to-market. And what that basically means is, when times are good and they're lending money out, what happens is they value everything. They put a like if you got a big business or something, the bank will come in and they'll do what's like called a floor plan, where they assess the value of everything in your business, including the building, the stock, the inventory, whatever you're selling or whatever else. They take and put a value on it. And when times are good, they value these things rather highly, and so then it's like leverage, you see? But when these margin calls go out, then they mark to market. And if there's no buyers, well, what you think stuff is worth and what it's really worth is two different valuations. So when they mark to market, generally it's the valuation is it can go through the floor, the valuation on things, as this kind of a thing once it gets started, this kind of a breakdown in the whole system. You see, debt. What they've done is they've leveraged the system up with debt, and the debt has been expanded to a certain point where it expands the monetary supply. But when the whole thing shrinks, it can shrink rather suddenly. And then they're forced with a situation, because what will happen is everything will go into receivership. Everything will just fold in on itself. They have to stop that. See, that's what happened in 2008. The exact same thing. Except this time it's going to be massively larger because they've leveraged the system up so much higher and greater. So what will happen is it'll start to melt down, basically, and they have to stop it. The system is so over-leveraged now at this point, if they didn't stop it, like if they just stand back and let this thing go, and let everything get marked to market, and let everything basically go into bankruptcy and receivership and everything else, and let all the derivatives fail and everything else, the system will just lock up and freeze. I mean, nothing will work. I mean, everything will stop. And they know if they let that go too far, if they let that advance for too many days, it's almost like, there's diseases out there. Doctors have to deal with stuff like this. Like if you go in and you got blood poisoning, for instance. Of course, they don't call it blood poisoning. They call it septicemia, I think they call it, or something like that. Anyway. And say it's going into your system, systemically into your system, so it's spreading everywhere through your system. If they don't get the antibiotics into you soon, when that happens, well, you'll die. And that's the way with the system out there right now. If this thing melts down and they don't stop it, it'll kill the whole system. It'll just lock the system up. And if everything were to lock up, if they didn't stop it and they let it advance too far, and if it locked the system up, then at a certain point they can't do anything. The system would just lock up so hard, lock up so tight, that at that point they wouldn't be able to unfreeze it or anything, because chaos would start to break out. And then what it would lead to is like it'd be like a trigger effect that would lead to more and more chaos, until in the end everything would just melt down, and we would actually go back to a financial stone age. It actually wouldn't be any finance at all. Gold and silver would, at that point, would be worthless, and the only thing that'd be worth anything is food. Food and water would be the only thing of value at that point. That's what it would melt down to if they didn't stop it. Of course, we all know that they're going to stop it, and the worse it is, the worse this effect is, the bigger the meltdown, the more they're going to hurry, the more that they'll rush in, and it'll cause alarm bells to go off within the financial system, and you'll see the central banks rush in to stop it. And that's what they will do. They'll rush in to stop it. But in order to stop, this is magnitudes greater than 2008. I would say at least 4 times as strong as 2008. What we're headed toward. And in order to stop it, they're going to need 4 times as much stimulus, if that makes sense to you guys. And, back after 2008, there was a lot of talk about hyperinflation. And in fact, they drove the price of gold and they drove the price of silver up to $50. They drove the price of gold up to $1,900 with their stimulus, And there was a lot of talk about hyperinflation, and people were buying silver like crazy, But it wasn't enough to break the markets to the point where we actually went into a hyperinflation. But now, with this situation we have now, if you get 4 times the effect, that means that gold's probably going to go 4 times higher than it did last time at 1900. That means silver's probably going to go minimum of 4 times higher than $50 this time around, when they do the stimulus. And it also means that when the crisis actually hits, there's going to be 4 times as much fear. And this time, they're going to put us into an inflation situation. Immediately, when they do this stimulus, they're going to put us into an inflation situation that's very much going to resemble what happened in the 1970s. You remember what happened in the 1970s? I remember it well. Interest rates, your bank account could make you good money. It could make you 10%. They're paying 10% per year on your bank account. So if you had $100,000, you get $10,000 interest in 1 year. That's the kind of interest you were getting, right? Good interest, And people, there was people out there who had a bit of money, maybe $400,000 or $500,000, and they were living off of their interest, and they were living like kings. How they stopped that inflation in the 1970s was Paul Volcker, the head of the Federal Reserve at the time, was able to raise interest rates up to about 20%. Because the United States could still service their debt at a 20% interest rate. We don't have that luxury now. Now they can't even get interest rates over 2%. So how are they going to stop this inflation this time? Because we're headed towards 1970s type inflation. That's going to be the initial phase after they come in and they fix this problem. Is going to be super high inflation. It's going to actually be what's called stagflation, because the economy is actually going to be going downhill. People aren't going to have the money to pay for anything, but yet you're going to see a tremendous amount of inflation. The answer to this is they're not going to be able to stop the inflation. And it's going to remain like the 1970s for a little while, maybe the first 6 months. Then it's going to get worse. The inflation's going to double again and get worse. After that first 6 months goes by with 1970s type inflation, some people are going to take the hint. And they're going to start moving heavily into gold, silver, and cryptocurrencies. Because they're not going to want to see the value of their fiat currencies go down to where they can't buy anything with it. It's going to scare them, some people. But a lot of people, the majority of the population out there, is still going to continue on. And they're not going to pay any attention. They're not going to buy gold, silver, or cryptocurrencies. They're just going to live with the inflation. And they're going to still work with the dollar. The vast majority of the people. But then after about 6 months passes, then we're going to move to the next level. The inflation's going to double again. It's going to get twice as bad. That's when more of these people that were holdouts were still using the dollar and they didn't panic and they didn't buy gold and silver. They're going to have to pay a lot more for their gold, silver, and cryptocurrencies. But then they're going to start buying it too. And that's when you're going to see the price of gold, silver, and cryptocurrencies explode. Guys, explode. About 6 months in. So I figure we got about another 2 or 3 more months before these problems in the world out there actually manifest themselves. But we got a couple more months. I don't think we're going to get past the 31st of October. I think that if nothing else triggers it, I think the Brexit will trigger it, because Germany's ready to go into a recession. And if England goes into a recession, United Kingdom goes into a recession, it's going to carry Germany into a recession. Germany goes into a recession. And you know, the river in Germany, I think it's called the Rhine anyway, the water level's low. And these factories all up and down there, they can't get their materials in to do their job right now. You know, plus the German economy is rolling over really fast. The whole thing's going downhill really fast right now. And so is the United Kingdom. These are two really big economies, you know. And Italy just, what is it about Italy and Deutsche Bank? They just keep going along, stumbling along day after day after day. They've been ready to collapse. Both Italy and Deutsche Bank's been ready to collapse for ages now. But they just can't, somehow they just keep stumbling along, you know. And they're both potentials. I mean, those are both potentials, either one of them, to take the system down. But they just keep stumbling along. They keep stumbling along, something else is going to take it down, and then because those are two dominoes that are ready to fall, they're going to go too. So we're going to move into this hyperinflation, and after 6 months it's going to progressively get much worse. That's when the majority of the people are going to start to panic. But they're going to pay an awful lot more for these assets you guys are already holding. In fact, during the first 6 months, these assets are going to be going up in value like you've never seen them go up before. And if you're a holder of these assets, these alternatives to the dollar, you're going to be really happy about what you see happen. And this is all getting ready to happen pretty soon. I'm kind of giving you guys a timetable. And probably about within the next 3 or 4 months, we're going to see it start. And then we're going to see it go along for about 6 months with the 70s style inflation. One of the things that's going to cause the 70s style inflation is this trade war. We're going to see a 10% on all Chinese goods markup in all the stores in the United States. They've said it's going to cost the U.S. consumer $200 per year extra. But that's baloney. Don't go by that figure. The reason why is because merchants, I know it's 10% on Chinese goods, but the merchants will mark it up probably 15%. And then what they're going to do is they're not just going to mark, I mean, okay, if they got 2 pairs of shoes in the store, one from China, one from America, if the Chinese shoes get a 15% markup, what do you bet the merchant's just not going to go along to the pair of shoes right next to it and mark them up too? If they're going down the store with their mark checker, they're just going to mark everything up. This is almost like a thing to merchants to mark everything up. So they're going to mark up, and they're not just going to mark up 10%, they're going to mark up 15, 20% on everything, and all the stores will be doing it. And so basically, it's like you're going to wake up some morning and go in, and everything's going to be 15, 20% higher than it was a week before on everything. And because we've had such a wet spring and such a messed up weather, well, food prices are going to be going up too. The same amount, 10, 15, 20%. And so that's not all. When the Fed has to fix the problem that's coming, that's going to help stimulate the inflation too. So this is what we got to look forward to. It's coming very soon. I hope you guys are preparing for it. Now, Europe's going to have an awful lot worse situation than over here. We're going to have it bad enough. We're going to have this super inflation and everything. But when this problem hits, because it's going to be probably centered in Europe, they're going to have to stimulate the heck out of the euro. They're going to have to They're going to have to go mad, stimulating and creating new euros to try to hold this thing together, to try to stimulate and prop up the European economy. And this is going to have a profound effect on the U.S. dollar index. When you see the United Kingdom represents, I think it's about 11% of the dollar index. When they have their problem and they break away from the European Union, watch the pound lose value And as the pound loses values, that makes up about 11%, I think it is, or maybe 10%, something like that. Makes up a certain amount of the dollar index too, along with 57% of the euro. Makes up 57%. So when you put the euro together with the British pound, you put the two together, you're getting up around, I think, almost 70% of the dollar index. What's that going to do to the dollar? It means it's going to push the dollar up on the dollar index. But that doesn't mean it's going to affect the purchasing power of your dollars. The purchasing power of your dollars is going to be bleeding away like crazy. At the same time, dollar index could be actually going up. What a weird world we live in right now, you know? Anyway, listen, thank you guys for listening to this show. We'll catch you again very, very soon. And I'm going to get this camera and microphone problems fixed pretty soon. I'm working on it. I might have to order a new camera. Anyway, but I got my cell phone here, so you guys might have to put up with cell phone shows for a couple days. Thank you guys for hanging in there, and we'll catch you on the very next show. Bye-bye, guys.